Financing a new machine is a significant challenge. The decision between renting and buying is usually easy, but harder to choose the type of financing to use once you've chosen the machine. Small entrepreneurs rarely have sufficient funds accumulated in a depreciation account at the bank to buy a new machine outright. If such funds are available, many investment opportunities compete for the same pot of gold. Almost certainly, you will need to look for some kind of financing. In this section, we will present 4 main methods of financing your new machine. These include a method based on renting and 3 methods based on financing. In addition, we will discuss tax strategies and other considerations. The first of the 4 options that we will consider involves renting. Renting means that you obtain the right to use the machine according to the terms defined in a rental contract, with no intention of acquiring the machine at the end of the contract. Most rental-only contracts are usually short-term agreements, and you recover none of your payments over the course of the contract. The rental fees, whether per hour or per month, are usually high. In comparison, with a monthly lease payment of 2 to 4% of the purchase price, dealers often base rentals on a rate of 5 to 8% per month. For small contractors, rentals normally involve used machines. Dealers rarely rent expensive new machines unless the rental involves a manufacturer's promotion or a large financially sound customer likely to give the dealer more business in the future. Rentals are potentially risky, as most contracts specify that you must return the machine in the same condition as when you got it. Renting a machine is most practical when you know that you won't need the machine at the end of the rental period, or when you doubt the machine's efficiency under your particular operating conditions. Machines such as scrapers and heavy-duty backhoes are examples of machines that you might rent for a specific short-term task, such as road construction. However, short-term rentals occasionally become long-term rentals because you develop an unanticipated ongoing need for the machine. For this reason, consider a rental agreement every bit as seriously as you would consider a purchase. Dealers will often let you insert a protective clause in the contract so some of your expenditures can be applied towards a specified purchase price. The remaining 3 financing options we will discuss are various forms of purchasing. Here, and in the rest of this section, it's important to understand that loggers use certain words differently from their strict accounting definitions. For example, accountants don't use the term leasing in the context of purchasing. However, from a logger's point of view, any equipment that is retained over its whole useful life is equivalent to a purchase. The lease plan is simply another method of financing the purchase. From a jobber's point of view, leasing is a form of purchase financing, so it sometimes goes by the name rent to own. A lease makes more sense than a pure rental agreement if you have long-term work for a proven machine. With a lease, the financial institution of your choice purchases the machine on your behalf, then recovers this cost by means of a leasing contract. Within certain limits, the contract can be tailored to meet your needs. For example, the initial payment, the length of the lease, the payment frequency, the amount of each payment, and the amount you must pay at the end of the lease if you wish to own the machine are all negotiable. One crucial advantage of a lease is you can make a relatively small initial down payment when you take possession of the machine. Lease contracts can take the form of a lease-to-own agreement in which you buy the machine for $1 at the end of the lease. Other typical plans assume that you must pay a final sum of between 10 and 20% of the purchase price to take ownership of the machine. Although you are not legally obliged to buy the machine at the end of the lease, it's often financially advantageous to do so. The second form of purchase we'll discuss, and the most common form, involves a conditional sales contract. In these contracts, you must make an initial down payment equivalent to 15 to 30% of the purchase price. Just as in a lease, you arrange the down payment and other terms of the contract with the financial institution of your choice. The machine becomes yours as soon as you have fully satisfied all the conditions of the contract. When it is time to replace the machine, the used machine often serves as a down payment on the replacement machine. All financial institutions offer conditional sales contracts. and many manufacturers and dealers offer comparable plans. The final form of purchase we will discuss is known as a chattel mortgage. In this form of financing, you must take out a mortgage on some of your property to serve as your security for a loan. Although you can use this form of financing to purchase a machine, chattel mortgages are more useful when you need short-term funding and funds are scarce, or when you are financing a new business. Chattel mortgages can be quite complex, and if you are contemplating this form of financing, be sure to obtain legal advice. Most financial institutions offer this form of financing. Which form of financing should you use? Depending on market conditions and the nature of your purchase, you may need to arrange some combination of all four types of financing with the dealer. For example, one common approach involves using a 6-month or 12-month rental to build some equity in the machine, after which you convert it to a conditional sales contract. Choosing from among the many options is difficult. Your decision must consider factors such as your expected use of the machine, its working lifespan, and your own financial situation. We strongly recommend that you obtain the services of a specialist who is experienced in the field of financing mechanical equipment. Such experts perform a financial analysis and recommend the best strategy for your situation. Because all large purchases have important tax consequences, the manner in which you decide to purchase a machine is extremely important. Financing specialists can perform the complex analysis required to help you maximize your tax benefits. For example, the time of year when you purchase a machine has significant consequences. If you are currently earning an unusually large profit, purchasing new equipment before the end of your current tax year lets you deduct a depreciation allowance from your earned income and save considerable amounts of income tax. In some cases, these savings may even lead you to replace existing machinery before it has reached the end of its useful working life. The actual amount that Revenue Canada and its provincial counterparts will let you deduct against your income changes occasionally, and there may be specific conditions attached to such purchases, so expert advice is important before you make any decisions. One factor that may help you choose among the various forms of purchasing involves the tax deductions available to you. For example, at the time this video was produced, leasing costs were treated as a direct expense and were 100% deductible from taxable income. Thus, if you pay 50% corporate income tax on your taxable income, each dollar spent on a lease reduces your income tax by 50 cents. Conversely, equipment purchases are treated as capital costs and can only be depreciated at 15% in the first year. Thereafter, 30% of the remaining balance is deductible at the end of each subsequent year. Based on these percentages, a corporate tax rate of 50% and an interest rate of 10%, the net cost of each dollar of capital cost is really only 62.5 cents. Certain equipment manufacturers, such as Caterpillar, Case, Dresser, Komatsu, and John Deere, offer their own financing programs. However, you must take care to ensure that these programs are compatible with the best interests of your firm, especially considering their tax implications. Shop around for the best interest rate. Small differences can be quite significant. For example, $100,000 financed over 60 months at 11% costs $3,000 more in real dollars than it would cost at a 10% interest rate. At the time of purchase, various other considerations can become very important at a later date. Often, for a variety of reasons, it is very important that the machine be at work by a specific date. Therefore, when you negotiate your acquisition of the machine, don't rely on a verbal promise. Try to get a written commitment that a used machine in good shape will be provided as a temporary substitute at the dealer's expense if there is any delay in delivering your new machine. To protect your investment, always purchase an insurance policy that covers at least the market value of the machine. Replacement value insurance is another option if you expect to be unable to replace your machine with a comparable used machine. A policy that covers the purchase value may be preferable even though the costs are higher. However, this option is generally only possible if the machine is not more than 3 years old. Lending institutions will require that you insure the machine and that the institution's name appears as the beneficiary. The insurance company may also demand that you equip the machine with an automatic fire suppression system to protect the machine against fires, even when unattended. When you negotiate an insurance contract, shop around. There can be a large difference in rates between companies for the same level of protection. Certain insurance companies refuse to cover forestry equipment, whereas others do, but at excessively high rates. Some specialize in this field and offer more reasonable rates. Currently, the annual cost of insurance most commonly falls around $3,000 for each $100,000 of the machine's estimated value, but costs can range from $750 to a high of $5,000. Thus, a reasonable cost estimate for a machine worth $400,000 would be $12,000 per year. However, depending on your geographical location and fire history, costs could well be higher.